Hello to those who have joined a minute or so early. We're going to get started here in about 1 or 2 minutes as the other people trickle in who are attending. And we will try to make a recording available for those who aren't able to make it or those of you who have to check out early. Thanks for joining today. I hope by the end of this webinar that you are as excited as I am about this one big, beautiful bill. We're calling it the O3B here in the office. It's got some great stuff. I think it's going to be great for a lot of people in a lot of ways. Let's hold off for about 45 more seconds, maybe a minute, and I will get started.
Okay, Mike, sorry for the late log on. I was just making sure you were on here and everything was all set up. Did we let the participants know to use the Q&A for any questions?
I have not yet.
Okay.
So if you do have any questions, you'll see a Q&A function button down at the bottom of your Zoom screen. Please direct any questions you have for me that you would like me to answer in that Q&A. You're also able to chat, but I am not going to be checking the chat while I'm talking. Feel free to chat amongst yourselves. Some people from our team might be tracking the chat, but if you want me to answer a question live, then send it in the Q&A and I will try to get them answered. I also have a few pre-submitted questions I'm going to get into here in about 30 more seconds. All right, it's 3:32. Sorry for those who are arriving later than this. I am too impatient, too excited to talk about this bill. I'm going to go ahead and get started. Um, July 4th, 2025, our president signed into law the O3B. It's a huge bill. I will agree, whether it's beautiful or not, I'll leave that up to you guys. It is one big bill. Um, and it was a lot of fun reading for me. I've read it now in its entirety 3 times. I've read parts of it multiple times, or some parts that don't exactly make sense to me, but it is a great bill. I think it's going to help our economy big time. Just there's a few areas that I'm just going to talk about quickly. One big one is 100% bonus depreciation is not only back, it is permanent, meaning it will take an act of Congress to take that away. Let me talk briefly about the history of bonus depreciation. The first bonus depreciation law that we saw was early in 2002 after 9/11. I had just started my career. I started my career in January of 2000. I'm still a very young CPA. I'm not even sure I had my license at that time. I was working at PricewaterhouseCoopers. And after 9/11 happened, everyone was shocked in the country. We were really worried about what was going to happen to the economy. We never had all of our air traffic shut down. We never had Wall Street shut down for a few days. Everyone was seriously concerned. And we thought we were going to immediately go into an economic spiral, at least a recession, if not potentially a depression. And man, there was a few months where Congress, Republicans and Democrats alike, were working together. I don't know if you remember this scene, but one of the biggest moving things I have seen um, in my life was when you had all of congressmen and senators, congressmen and women and senators from both parties united, standing on the Capitol steps singing our national anthem together. They were truly united. The only time I've seen that happen in my lifetime, and they were united for like 2 months, and then they got back to normal. But back then, normal wasn't as partisan as it is today. All that being said, they all agreed, hey, we need to incentivize businesses to invest in their business. That's the only way, or one of the greatest ways we can potentially stave off this recession or depression that is probably coming. And they came up with the first retroactive tax cut in my career. And they said anyone who bought equipment In this case, I think it was 15-year or less in useful life equipment. Last year, instead of having to capitalize and depreciate them over their useful lives, you can take 50% right off the top. It's a 50% bonus depreciation. And boy, did that work. When you looked at the Fortune 500 companies and their financials that they were posting, all this was audited. So this was real empirical evidence. They doubled, tripled, quadrupled, in some cases 10x their capital expenditures, because not only did they need the capital improvements for their businesses, but the IRS was incentivizing it by providing them some type of immediate deduction. And it worked. It worked well. I believe that bill expired after 1 year, and it might have been two. I get the history a little confused. But immediately as it was expiring, Democrats and Republicans alike, George Bush was still the president, but Democrats were in charge of a good part of Congress, I think half of it, and they all agreed, hey, wait, that expired. We want this back. We want to continue to incentivize the economy, and they came up with 60% bonus depreciation and reinstated it. Since then, bonus depreciation has expired and been renewed under Republican presidents, under Democrat presidents, under Republican Congress and Senate, under Democrat Congress and Senate, because it has proven itself when you are allowed to deduct the money you spend on buying equipment or capital improvements for your business, people will spend more money and grow their businesses, and it grows the economy. So fast forward 2017 Tax Cut and Jobs Act under Trump's first term, 100% partisan bill. I don't believe any Democrats voted for it, but they brought bonus depreciation back to 100%. However, it was going to start phasing down in 2023 and be completely gone by 2027. It did its trick. People spent money on capital improvements, but it had gone down. And this year we were looking at 40% bonus depreciation in 2025. 20% in 2026, and 0 in 2027. Now we have 100% for any asset placed in service, not bought, not purchased, but placed in service for the use of that asset in business after January 19th. So basically, January 20th is the cutoff date or the start date, 100% bonus depreciation. And this time, for the first time ever, it does not phase out. It's 100% from here on until Congress changes the law. I think this is going to be great for our economy. It's definitely great for our taxpayers and our clients who can utilize it. You can only utilize it if you have a trade or business, but if you do have a trade or business, you can get 100% bonus. It follows the same laws that we had from the 2017 Tax Cut and Jobs Act, just no phase out and no sunset. It is here. And how long it stays to be here, I mean, I'd say at least 4 more years. I can't imagine Donald Trump signing any law that removes bonus depreciation. Could it change again in 2028 or 2029 under the new administration? Absolutely. Will it? I doubt it, but hey, I can't predict our politicians. All I know is they're sleazebags. They all lie, almost all of them. But we've got it at least through 2020, early 2029. Okay, so on that, a couple other things I think are great for our economy is the research and development expenditures. As part of the 2017 Tax Act, in order to balance the budget on the reconciliation, they agreed to remove the ability for companies to deduct, and this was Donald Trump's bill, but to remove the ability for companies to deduct research and development costs. Their thinking of the time was, by the time that happens in 2022, we'll have enough support to reinstate it. Well, guess what? The Republicans weren't in charge anymore. Neither was Trump. And it didn't get reinstalled. So for the first time ever, our first world United States was the only first world country, and heck, the only second world country that didn't allow their businesses to deduct research and development costs immediately. They were allowed to amortize it over a longer period of time, but they weren't allowed to deduct it. This put our country at a big disadvantage. That's back now, 100%. It's permanent. You can deduct your R&D expenses, and we still have an R&D tax credit, so you can also get a tax credit on that. Those are the two main things I want to highlight now, and before I get into some Q&A and questions that have already been pre-submitted. Is Edward Jenkins on? He is not. But Edward asked, hey, we purchased and put into service a property in 2024. We also had a cost segregation done. Intention was to claim bonus depreciation in 2024, when the bonus depreciation rate was 60%. I'm adding. We requested a filing extension, have not yet completed. Can and or should we consider claiming bonus depreciation on this property in 2025 instead? From Edward Jiricles. It's not going to change what your tax is. The rule is if it was placed in service on January 20th or later, it's eligible for 100% bonus. If the asset was placed in service in 2024, you're going to get 60% bonus. That's the way the law was written and signed into law. I'm sorry, Edward. There is another client of ours that we're working with who maybe thought and tried to make sure her property was placed in service in 2024 for bonus. But the way it happened, she worked with some friends of friends who went and stayed at her place, and paid her for it. And we're working with our tax attorney on staff, Roland, who going to try to figure out if there's a way, since they truly weren't a lot of degrees of separation. Maybe they can refund those fees and get good Google reviews on their property, and maybe we can claim it was placed in service. In fact, they only had 2 guests in December that were kind of related to them, and no real guests until February of 2025. I think there's a chance for that person to get bonus. Edward, I don't know what your fact set is or if it's even possible. With that said, that's the only pre-submitted question I think I have. I'm happy to open up with you guys. Otherwise, I will go into what our team has found are the top searched question on Google about this bill, and I'll start answering those. But let me open the Q&A. We see no questions have been
No.
submitted.
We have a quiet bunch here, Mike. So if
Yes,
anyone
we
has
do.
something, drop it in the Q&A for us. Otherwise, we'll go forward with some general questions that everybody seems to have.
Yeah. One of the top search terms is, can you go into more detail on how these tax changes could lower my tax liability? Well, for one, they maintain instead of expiring. Now, remember, the current tax law that we've been working off of and the current tax brackets we've been working with are the ones that were established in the 2017 Tax Cut and Jobs Act. All of those tax brackets and a whole bunch of the provisions were going to fully expire by the end of this year. Now they are not. So we have the same tax brackets, and we're going to continue their permanent tax brackets unless Congress and the president change it again, of where we're at. So that's going to lower your tax liability after 2025. We have an increase in standard deduction amounts for everyone if you're taking standard deductions. So that can lower your tax bill as well, and most likely will, especially for those who are of retirement age and don't make a lot of money. They're a married couple over the age of 65 that doesn't make over a certain threshold of money, that aren't wealthy or well off. They're going to be able to deduct as a standard deduction almost $45,000 this year. Also, if you have children, they increase the child tax credit to $2,200 per child. And that's also permanent, and it's going to stay that way. So that will help your tax liability. Then that's just for individual taxpayers. If you're a business, there are tons of things that can lower your tax liability. And I'll get through some of those here. I've already talked about bonus depreciation, research and development costs. I'll get through some others as I go through the rest of these questions.
We do have, yeah, we have one in the Q&A now.
So Dan asks, are people on visa also eligible for whatever this bill has to offer, especially with depreciation using STR loophole? For your specific question, Dan, I think yes. I don't know, as long as you're a legal resident and you're a U.S. taxpayer, absolutely it applies to them. Some of the things that were actually negative for non-U.S. citizens or people who aren't here legally, and this doesn't go in the tax world, but there's some Medicare and Medicaid privileges that used to go to any resident, legal or not, that no longer do, but they do go for legal residents. There's some other things like student loan deferrals or even repayment by the federal government. Those won't go to anyone now except U.S. citizens. But most of these tax advantages, Dan, do apply to any legal U.S. resident that has to pay taxes in the U.S. Just a quick note on that, bonus depreciation is only eligible for property placed into service here in the United States. In any of the 50 United States plus the District of Columbia, doesn't apply to property you bought in Belize or a property you placed into service in Puerto Rico, which I'm surprised. I thought they were going to add Puerto Rico into it. Didn't look like they did it in this bill. So I'll mark that as done. Feel free to ask follow-ups, Dan. And next question, highly Googled question. What are the actual deductions and credits can I claim starting this year? I would need 2 hours before I go through all the newer ones, but obviously you get the 100% bonus if you're in business or opening a business or starting a business. If some of you aren't interested in starting a big business or aren't buying a short-term rental or a rental property of some sort, but you would like to take advantage of this. One cool thing I've seen client after client do, and I want to do it to get a Cybertruck, but my wife is saying no because she's right. She'll end up doing most of the work and she doesn't have the time, is getting a Turo vehicle. If you buy a vehicle to use in a trade or business, like a Cybertruck, which weighs over 6,000 pounds, has the big enough bed in it to qualify for bonus depreciation, I could go buy a Cybertruck now with like $5,000 down. 0% interest Tesla's offering right now through September 30th. I could buy that and deduct the whole $115,000 purchase price, even though I only paid $5,000 down and I pay the rest over 60 months. I could deduct that. And if I materially participated in my business, my Turo business, or if my wife materially participated and she said no, then I could take that deduction against my active income. Yeah, there's a few other things I'm going to get into in these further questions, but man, there's a lot of deductions, new ones or ones that aren't going to expire now that we could go on for a long time. Another big search question is to expand on the tip income and overtime and how that will affect me and my business. Well, the basics are this. If you're an individual and you make under $150,000 total in tip or overtime, you can take a top of the line deduction of $25,000. If you're married, your threshold starts at $300,000. So as long as you make less than $300,000, you can take $25,000 in overtime pay and $25,000 in tip income, tax free. Anything above that is taxable. That does expire, I believe, in 2029. It's a 4-year deal. I don't know if it expires in 2029 or in 2030, but it expires. How would the bill affect depreciation and capital expenditures? I think I've talked about that. 100% bonus depreciation for any asset placed in service after January 19th, 2025 that's used in a trade or business that has a 20-year or less useful life. One other cool thing I think is going to be very helpful to our country, and I was impressed that anyone in Congress thought of this, but it was really smart. If you're trying to, one, grow our economy, two, re-onshore a lot of the jobs and a lot of the production that we used to have here, but now has gone to cheaper places. If you buy a warehouse or build a warehouse or retrofit a warehouse that's going to be producing things here in the US, normally you would have to depreciate that building over 39 years. There's a carve out now in the new bonus depreciation rules that says if you do that and you're manufacturing stuff here in the United States, you can take that 39-year warehouse or retrofit and deduct it all immediately, 100% bonus. Dan asked a follow-up question. Let me get to that before I move on. Let's assume I put my property in service this month. If I do a cost seg study this year, would I still be eligible for 100% depreciation, or will I be eligible in 2026? If I were to get the 100% depreciation when I sell my property in 5 years, do I owe taxes back since I claimed 100%? Great 2 questions. Let me start with the first one. Yes, you would be eligible in 2025 to take bonus depreciation if you place it in service this year after January 20th. You would be able to take the depreciation amount or bonus depreciation amount on the assets that have been segregated out in your cost seg study. And you would take it in your 2025 tax year, but you wouldn't file for that until 2026. That tax return would originally be due if you're an individual, April 15th, 2026, or March 15th, 2026 if you're a business. And you could extend it. So the cost seg, you just need to have that done before you prepare your tax return to file to, to file and take the benefit of the cost seg. If you took it this year and sold the property in 5 years, you likely may have to pay some taxes back in the form of bonus depreciation. And it creates something called depreciation recapture. So I'm not going to go into all of the details and caveats of depreciation recapture. The very basics are, if you get to offset your ordinary income with bonus depreciation or accelerated depreciation, and then you turn around and you don't hold that asset for the life of its asset, and you turn around and sell it, normally property used in a trade or business that you sell is eligible under IRC 1231 to be treated as a long-term capital gain, assuming you held it for over a year. Long-term capital gains rates are less than ordinary income rates. You pay 20% long-term capital gains tax, and if you're subject to it, which most people are, you pay an additional 3.8% Obamacare tax, or net investment income tax, it's called. So you'd pay 23.8% on that if you never depreciate. If you took 100% bonus depreciation, part of your gain is going to be subject as ordinary income. All depreciation recapture does is shift some of or all of your gain on sale. Instead of it being treated as long-term capital gain, it's treated as ordinary income, taxed at your highest tax bracket. So assuming you didn't buy anything else or you didn't go do any other tax strategies in 5 years when you sell your property, in theory, you'd owe a little less amount of tax than you save today, because depreciation recapture goes down a little bit each year as you catch up with what normal straight line depreciation would be. However, my philosophy is, Dan, you always defer taxes as long as you can. Why? Tax law might change. You might find more deductions. If you can predict when you're going to sell an item, you have plenty of time to come up with other tax strategies that can eliminate or mitigate that depreciation recapture. But let's say you're not doing any of that. Let's say you buy this property and you save $40,000 in taxes today. And then 5 years from now, you sell the property and you have to pay that $40,000 back due to depreciation recapture. You got to keep $40,000 for 5 years. If you put it just in a normal CD, interest-bearing account, making 4, 5, 6% over the next 5 years, that 4, 5, 6% that you make over the next 5 years, and hopefully you're reinvesting and compounding it, you will always have that difference. That is yours. That permanent delta you will always have, thanks to the time value of money, versus if you pay the $40,000 in tax today, you don't have the opportunity to earn money off of it. From a business perspective, saving taxes today gives you more capital to put into your business now to make more money next year. Time value of money is very valuable, but it's hard to see that. Now, if you're going to sell the property next year, most of the people in my firm would recommend don't do the cost seg, don't take the bonus. It's going to hurt you, because when you do a cost seg and take bonus, you're paying a cost seg engineer to do it. That's money out of your pocket, guaranteed. You're paying your tax preparer, if you're paying one, more money to implement the cost seg than you would if you didn't take it. So you got to figure out what that cost is versus what your tax savings are, and your negative tax savings or your depreciation recapture tax next year. And even if you make 6% on that money, compare what you can make on that money to your actual out-of-pocket cost for the cost seg engineer, and decide which is better for you. Do it or don't do it. Hopefully that answered your question. Please keep asking them, Dan. You're the only one asking questions. Let me get back to my pre-canned Google searched questions. Um, wait, actually, let's see. How will the bill? Let's see. We got to that one. Sorry. How does this bill affect small business overall? Small businesses overall. What is my take on it? Well, we had this cool pass-through deduction, otherwise known as the QBI deduction, the qualified business income deduction, or the Section 199A deduction, or the pass-through deduction. That was created in the Tax Cut and Jobs Act in 2017. It's about to go away at the end of this year. Now it's back and it's permanent. It's still the same percentage. The House bill was asking for 23%, maybe even higher if it was purely a U.S. domestic business. But the Senate changed it back down to 20%, but made it permanent. That means any small business, unless you're um, unless you created your business or structured your business as a C corporation, if the money's coming through to you through some kind of path through an S corporation, a sole proprietorship, a partnership, or disregarded entity, you get this free potential deduction of 20% of your net income. Um, all small businesses are eligible for it. However, there are certain things that are called specified services and trade and business that they have limits. If they make too much money, they don't get to take advantage of this deduction. I can as a CPA. If the money you earn and the main draw for your clients is your professional reputation, so think doctors, lawyers, attorneys, architects, if that is the main reason that people are paying you money, you are in an SSTB. You can't make over $450,000 if you're married, and that's adjusted for inflation, and still take this 20% deduction. The purpose of the QBI deduction, and I believe in it and I'm a proponent of it, is right now, big corporations, big multinational corporations have so many ways to avoid paying taxes. Even if they're not doing any tax mitigation, they're only paying a flat 21% of their taxes. Whereas if you're a small business and you pay tax at 37%, you're paying 37%. I think the small businesses deserve just as much dry powder, just as much capital that they should be able to keep each year to grow their businesses so they can compete with those big businesses. The QBI deduction serves a big purpose and it's a lot of help in trying to be able to compete against the big dogs. I, as a small business owner, am doing exactly that, and I greatly appreciate this deduction. Other small businesses, I'll get into a few more. I have one question that further down that gets into a lot of those things. Let's see. Will energy or real estate tax preferences be expanded or rolled back? Energy, yes. Real estate, no. It's actually better now. So let's talk about the energy credits. I enjoyed these. I didn't get a electric vehicle. Again, that's my wife's fault, but I didn't get one, so I didn't get the $7,500 EV credit. But that credit expires for any vehicles bought after September 30th, 2025. You may have seen Elon Musk and Donald Trump's falling out. I believe that is a big reason why, because people don't get government subsidies now for buying electric vehicles that they used to get. Like it or not, that's the new law. If you're going to buy an EV, buy one before September 30th. But do understand there are big phase out limitations that are, they consider you rich when you're not rich for these phase outs. And if you make too much money, you can't get that $7,500 credit anyways. There's also a business vehicle credit, $7,500 that businesses could avail for them, and they don't have the income thresholds, but they need to be business vehicles. That also expires after September 30th this year. Solar panels, I did take advantage of. I have more solar panels on my roof than I needed. I filled up every square foot that the building codes allow me to do because the government paid me 30%. I got a tax credit of 30% for it. That you can still do up until December 31st this year. It expires completely. I don't like that part of the bill. I do think it was good for the government to incentivize people to have homes where they're creating their own electricity and they're creating their own clean electricity. But that was one of the compromises they chose to make, and they got rid of that. You can still do that this year. Just make sure your panels are up and running in service by December 31st this year. I just read a recent article in the Wall Street Journal about that, where people all over the country, the solar providers are going crazy now because they got more business than they can handle. But they're terrified because they know they're going to have zero business or hardly any business next year. Um, Real estate, yes, it's better. Bonus depreciation mainly. Will capital gains or dividend tax rates change? No. If so, should I rebalance or harvest gains or losses under new rules? No. The only difference that could be applicable here is the new opportunity zone tax laws. They brought back opportunity zones and they brought them back on steroids, and it's a great opportunity. I was just talking to a prospective client a couple hours ago. He got mad at Elon Musk and sold his stock in February or June of this year, I mean, and I guess it was February this year. That's the same time I happened to buy it. He sold it. He has a $3.5 million gain. He's been holding on to it for 5 years. What can he do with it? I talked to him about opportunity zones. He has 180 days from the day he got that money to invest it into a qualified opportunity zone fund. He can create his own opportunity zone fund if he wants to control the interest, maybe in a rental property. He can do that. If he does that, he gets to defer however much he invests as a gain. He won't have to recognize his taxable income on it this year. And he gets to defer it for 5 tax years. And then in 5 tax years, if he still has that investment, he gets to defer 15% permanently, but recognize 85% of it then. However, then if he continues to hold on to it for another 5 years before he sells that asset, whatever gain he makes on the sale of that asset is 100% tax free. The big difference in this new OZ law versus the old OZ law, there's no artificial arbitrary cutoff dates. It's permanent now. It's going to roll indefinitely. Anytime you sell something, you start your own 5-year clock. 180 days to invest, 5 years before you have to report the taxes, 10 years from when you defer the tax to be able to sell it. And whatever you're selling, tax free. You can do that with real estate. You can do that with businesses. You can do that with business. There's so many things you can do that with. The big complicating factor is you have to invest it through a qualified opportunity zone fund, which I think is really dumb and unfair. But there's a workaround where any of you can start your opportunity zone fund. You just got to file a partnership return for the next 5 or 10 years in addition to your personal return, and file the necessary attachments each and every year. We are very happy to help you guys out with that if you're interested. So do I foresee any adjustments to the bill? Absolutely. There's a lot of things that MAGA Republicans didn't get in this bill that they wanted. They might be able to push something like that through Congress in the next 2 years or next year, I guess, before the elections come up, and the House potentially flips. There's stuff bipartisanly that they wanted in here that didn't make it in. I do expect new legislation to come out this year, and in the next 2 years. I just have no idea what, but we'll see. Are there temporary incentives or sunset clauses I should take advantage of now? Yep, the EV and solar I already mentioned. The Trump accounts. I hate the name of these. They were first in the House bill called MAGA accounts. Then the Senate called them Trump accounts. Like it or not, love Trump or hate Trump, the fact is half of the country can't stand the guy. When they hear that name, it brings pain to their hearts. We should have called it anything else because these accounts are actually beautiful, regardless of what they're named. These are an opportunity for families to put away up to $5,000 a year in their children's future. That can be used for medical expenses. It can be considered like a retirement account. It grows tax-free. If you use it as a qualified distribution, it comes out tax-free, just like a retirement account, a 401k or an IRA. They can use it for their elementary school, their high school, their college. They can use it to buy a first-time home. They can use it for medical expenses. They can use it to start a business. I love those. A lot of people can't afford to put money away, so the government for the next 4 years has committed to providing every person's child. I think there's going to be income thresholds, but I didn't see that in the final law. We'll see how the Treasury Department makes the regulations. But if you can't afford it, or even if you can, the government will provide you $500 per year per child to put these accounts up. If you don't even create an account, the law calls the Treasury Department to create those accounts for you. Don't let the government create your own account. Create your accounts. No telling what would happen if the government's in charge, but create your accounts, create these MAGA accounts. Another cool thing for employers is an employer can pay an employee to fund those accounts up to $5,000 a year. It's not taxable income to the employee, and the business gets to deduct it, and it goes into their child's Trump account. On to the next one. Does the bill have any changes to estate tax or business succession planning? The main thing is, yes, it increases the limit that you're allowed to die with before you have to pay estate tax to $15 million per person or $30 million per married couple. That's going to mean truly only the richest people are going to owe tax. And even the richest people don't pay much estate taxes. They pay people like us and other firms out there to do estate tax planning. If this bill hadn't passed, next year it was going to revert back down to around $7 million. I'd call that a huge change. Another question I had, I'm down to my last two questions, but this one's a 7-part question. Are there changes to employer tax credits for hiring, training, or offering benefits? Yes. Now there's a pretty nice credit for employer providing childcare. It's a maximum. There was a smaller one. The maximum used to be $150,000. Now employers can get a tax credit for up to $500,000. It went from 25% of what the employer spent to 40% of what they spent. And even for qualified small businesses, 50% of what they spent. And there's some other requirements, and that only starts next year, not in 25, but it starts January 1st, 2026. Paid family and medical leave tax credit. I'm happy about this because now we do provide maternity leave, not according to FMLA, which is, I think, 3 months. We provided a month for our people, and we've just done that because it's the right thing to do. Now, the government is going to give us 25% of what we paid as a tax credit. All small business are eligible for that, up to 12 weeks. Or if you're buying a FLMA insurance policy to cover your employees, you can get similar type credits for that. We've got, it extends the work opportunity tax credit. A lot of those parts were expiring, but right now, if you hire disadvantaged people, poor people, felons, whole list of people, look up the work opportunity tax credit on Google, you'll see the list of people. It's extended it now for a good bit of time. R&D tax credit, it has been extended, it's there. And it not just the credit, but you can also deduct the stuff. There is a credit for wage growth. If you're an employer and you give your employees raises, and I mean, it's a complicated formula. I haven't actually studied it yet, but there's a way to get a tax credit as an employer for it. Also makes permanent student loan repayment as tax-free and deductible. So an employer can pay an employee's student loans off. There's an annual limit about it, but they can do that. It's deductible for the employer. It's not taxable income for the employee. And then we already talked about the Trump accounts. An employer can pay up to $5,000 a year to fund their employees' children's Trump account per child and deduct it, and no one has to pick up taxable income for it. And then the final number one search bill question was, will this bill change how I have to report or pay for contractors versus employees? The rules of who's a contractor versus who's an employee have not changed at all. But the threshold of when you have to issue a 1099 to a contractor or anyone else you pay who's not a corporation, it used to be $600 a year. My entire career was $600. You pay anyone $600, you have to issue them a 1099. They've now lifted that up to $2,000 for this year. So you pay someone $1,999 during the year, you don't have to issue them a 1099. Anything more, 2,000 and up, you do. And this time it's subject to inflation. So it'll go up and up every year as inflation goes up, unlike that prior $600 that came out way before I started my career. I see Jody Evans asked a question. Hey, Jody, on the Trump accounts, do children have to be born in 2025? No, they have to be under the age, I think it's 8 and under. I hope it is 8 and under because my eldest son will work. My eldest son is 8, and yes, I can set one up for him. in order to get the government to pay for it. I don't know if I can still contribute to him going forward once he's 9. I think I can, Jody. I don't know. I'm not an expert on this bill yet, even though I've read it 3 times. But I do know the government will give me $500 per kid that's under the age of 8 for the next 4 years, and then that part goes away. I hope that answers your questions. And that is the last question I have, or anyone else send in. Does anyone have any other questions? Please feel free. You can raise your hand. I'll put you on chat, or put it in the Q&A. I'm not reading chat. Well, there you have it. I'm guessing there's no more questions. I hope you guys are as excited about this O3B bill as I am. It's going to be big for our country, huge for our clients. If you need help, feel free to reach out to us. Go on our website, click schedule a free consult. Be happy to chat with you. And if you like what you hear from us and like the service we provided you, if you are clients, please consider referring us to someone else. We want to help people keep more money that they have worked hard for, not let it go to waste with the government. That's what we do. If you know someone else that could benefit from that, please do send them our way. Thank you, everyone. I hope you have a wonderful, wonderful rest of this week, and see you next time.